Imagine waking up tomorrow to find the price of everything you buy has jumped 40% overnight. Not because of war, not because of a pandemic, but because the world's debt mountain finally cracked. That scenario is no longer theoretical. In the last 48 hours, the yield on the benchmark 10-year U.S. Treasury note spiked above 5.1%, the fastest three-day move since the 1987 crash. Japan's finance ministry openly warned it may stop buying foreign bonds, and the IMF released a single line in its latest report that sent traders into silence. Global public debt will exceed $100 trillion before the end of this year. This is not another routine market wobble. This is the moment the post-2008 debt supercycle began to unwind in real time. Why is the world reacting like this? Because interest payments on government debt are now the fastest growing budget item in 71 countries. Central banks that once promised lower for longer are trapped. Raise rates and governments drown, cut rates and currencies collapse. Markets are pricing in the first true sovereign debt stress test in modern history. What we are watching is bigger than any single economy. It is the visible fracture of a 40-year experiment. The idea that entire societies could borrow indefinitely from the future without consequence. That experiment just hit its natural limit. And the scariest part? The numbers you're seeing on the screen right now are still the polite version, the ones governments want you to believe. But behind those numbers lies a mechanism most people have never heard of, one that turns manageable debt into an uncontrollable chain reaction. The real trigger isn't the size of the debt, it's the speed at which servicing costs are compounding. Here's the mechanism nobody talks about on television: duration convexity. When interest rates rise, the market value of long-dated bonds collapses exponentially, not linearly. A 1% rate increase on a 30-year bond destroys roughly 20 to 25% of its capital value instantly. Pension funds, insurance companies, and banks that are forced to mark these losses to market suddenly face capital holes measured in trillions. That's the hidden accelerant. Now layer on the psychological loop inside central banks. Behavioral game theory shows that once a major player, think Japan or China, signals it might reduce bond purchases, every other institution front-runs the exit. It's the same prisoner's dilemma we saw in bank runs, only this time the bank is the entire global financial system. And then there's the quiet currency war nobody declared. Emerging markets owe roughly $11 trillion in dollar-denominated debt. Every 1% rise in U.S. rates increases their annual interest bill by $110 billion, money they don't have. Default cascades become mathematically inevitable above 6 to 7% yields. The stakes are brutally simple. If the developed world keeps rates high to protect its currency, the developing world implodes. If it slashes rates to save the periphery, its own retirees and savers get wiped out through inflation. But here's the part nobody expected, the one indicator that just flashed red for the first time since 1945, and it's happening in a market most viewers have never heard of. Walk into any fixed income trading floor right now and ask for the basis swap spread between U.S. Treasuries and German bunds. Traders will go quiet. That obscure spread just went negative for the first time ever, meaning the world no longer trusts even the safest government bonds equally. Europe sees this as America weaponizing the dollar one last time. Asia sees it as the end of export-led growth built on cheap Western borrowing. The Middle East is quietly converting oil revenue into gold at the fastest pace since 1973. History gives us only two clean parallels. Rome in the 3rd century, when the denarius was debased 98%, and Britain in the 1920s when it tried, and failed, to return to gold at pre-war parity. Both times the trigger looked technical, until society itself fractured. Behavioral economics explains why almost nobody is panicking yet. Exponential functions are invisible to the human brain until the very last moment. We're wired for linear threats, a storm, an invasion, not for compounding interest that doubles every 8 years. Power structure theory adds the final piece. Debt has been the primary tool of geopolitical control since Bretton Woods. The moment a critical mass of nations can no longer service that debt in the reserve currency, the entire hierarchy of global power resets. It gets deeper. Because while markets fixate on bond yields, an entirely separate shadow system, now larger than the official one, just crossed its own breaking point. For families, this means the era of the 3% mortgage and the 0% car loan is over permanently. Real wages, already stagnant for 2 decades in most developed nations, will now face a multi-year squeeze as governments tax quietly through inflation or cut services to pay bondholders. For workers, pension funds that assumed 7% annual returns forever are quietly marking portfolios down 20 to 40%. Many will never recover in the working lifetime of anyone under 50. Markets are about to discover that risk-free assets were only risk-free because someone else was secretly absorbing the risk. That someone was you, through future taxes, through currency devaluation, through the slow erosion of purchasing power. The part the media isn't discussing. The great wealth transfer has already begun, not from poor to rich, but from everyone who needs to borrow to everyone who already owns the bonds. It's the largest forced redistribution in history, and it's happening in slow motion, 1 basis point at a time. Here's the pattern interrupt. While the entire world stares at government debt clocks ticking past $100 trillion, the real transformation is already unfolding somewhere else. Off-balance sheet central bank swaps now exceed $15 trillion. Private credit markets, the unregulated shadow lenders, have grown to $2.5 trillion and are freezing exactly like 2008, only bigger and faster. Because the debt time bomb everyone is watching is actually the decoy. The real explosion, the one that will rewrite savings, salaries, and societal stability for a generation, is happening right now in a corner of the financial system that still doesn't appear on any government ledger. And when that one detonates, cash will no longer be trash. It will be the only thing left that still works. The next move isn't coming from Washington or Beijing. It's coming from a quiet room where the world's collateral is being revalued in real time. And when that door opens, nothing will ever be priced the same again. See you in the next transmission.